Okay, guys, I hope you've been following through with the question that I had to put up last time. So if you followed through, today I want to continue on the current account. Current account, okay. What's consisted in the current account? Last time I explained to say the current account is the extension of the capital account. Exactly the same ideas you have about the capital account, that's the same ideas that uh, takes place in the current account. Okay, so in the current account, normally we record from the credit, okay, from the credit. Reason being, just like in the capital account, we record from the credit. The capital is recorded on the credit to symbolize that that capital is a liability. The business owes that money to the business owners. That's the reason we record that money on the credit side. So the normal thing for a capital account or a current account is to have a credit account. Where we have a debit account, like in the case of Hara, then something unusual might have happened. It means Hara has nothing as capital. Hara overused his benefits and hence having the debit balance. Okay, so from our question, the data that we had balance brought forward for these guys. You can tell that Banda has a credit balance and Zulu has a credit balance. Only Hara had the opening debit balance. Okay, so in the current account, that's why we record the benefits for each partner. Whatever they are benefiting personally, individually, you credit those. So you can tell by interest on capital. The capitals, the partnership charges, let's say the partners charges interest on their capital. So the partnership must pay them that interest. So it's a benefit to each partner. So that percentage we had in the question, if you multiply with the capital, you're going to get these figures, the interest on capital and their salaries. Banda is not paid any salary, so he doesn't have any gain on that part. Only Hara and Zulu are paid the salary. So you credit those benefits and the share of profits. At the end of an accounting year, when the profit is calculated, the profit that we calculated from the statement of profit and loss is shared in the profit sharing ratio, the ratio that we have. If you do your mathematics, you find that these are the figures we are getting as the shares per each partner. And then we are coming up to balance. These are the only benefits they have, so you have to close the accounts by balancing. Balancing the accounts, I'm sure you know, we start with the side which has the bigger figure, closing balance. Which side had the closing, the bigger closing total here. So you balance up like this, you find that only Banda had the credit balance of 74,940. So this means only Banda has money in the current account. The rest overused their benefits. This is the reason they are having a debit balances here. So the debit balance brought down, we have we are going to have only these Hara and Zulu have the balance carried down. If you bring down these balances will come to the credit side, which means only Hara and Zulu have money in their current account. Banda has a balance brought down, balance carried down from the credit. If you bring down this one, it's going to go on the debit side, which means that Banda doesn't have any benefits in the current account. So that's how you work out the current account. It's not that hard, it's simple and straightforward. Where you don't understand, please hit me up, I'll be able to explain. So down here I have the statement of financial position. I'm sure most of you are aware how the statement of financial position works. We start with the non-current assets. So we only had computers and office equipment. If you do, so this is the cost, and the accumulated depreciation. Accumulated depreciation is a depreciation from the period and the current period. So in the question we had some figures. If you had the current depreciation in the additional information, you will discover that accumulated depreciation is coming to the 2,000 for computers and 20,000 for office equipment. And then the net book value, same as the carrying amount, is this, and then these are the total non-current assets figure as the net book value that we have. Then you're going to put up, of course, the current assets from the data that we had. Closing inventory is a current asset. Closing inventory is a current asset. Trade receivables, bank and prepaid administration. We overpaid for administration expenses, so it's a prepaid. Okay, these are the figures. And then you also work out the equity and liability part where you put capital. So with partnership, here we have the current accounts figures appearing here under capital, because the current accounts, they are an extension of capital, so they will appear here. The balances, you add them up, then you're going to add them to capital, and then you do the liability part here. We only had the current liabilities, which were trade payables. If you do your workings properly, you discover that the balance sheet is actually balancing. The statement of financial position was balancing. We had total assets at this, and equity and liabilities. This is the figure below. Thank you very much. I appreciate your time. I was rushing. Hopefully my explanation has made sense and you've understood. For anything more, please, I'll be waiting for your questions. Thank you.